Welcome to another insightful session with Informed Investor. Now, tax planning is an essential aspect of personal finance for every single individual in India. With the government revising the new tax regime for fiscal year 25-26 in the recently announced union budget, many taxpayers are left wondering, should I stick with the old tax regime or switch to the new tax regime? Which one actually helps me save more? Now, if you're confused about which regime is better for you, you are not alone. The decision isn't just about tax rates, it depends on your income, deductions, and financial goals. That's exactly what we'll break down in this video. We'll break down the newly announced new tax regime for the financial year 25-26 and compare it with the existing old tax regime. We'll explore the key changes, compare tax slabs, and help you decide which regime might be better for you. Lastly, we'll also talk about the key highlights of the Income Tax Bill 2025. So let's dive in and make sense of it all. You're watching Informed Investor, an initiative of Equentis. Now, before I start, I want to lay down some facts ahead of you. There were about 8.09 crore individuals who filed the returns in fiscal year 24. And with the current population of 142.86 crores, this means that only 5.6% of them actually paid income tax. Even if we consider just the 96.88 crore eligible voters, the number barely rises to 8.3%. So just imagine, only a tiny fraction of India is actually paying taxes. Now, another point to be highlighted is that out of the total number of taxpayers in assessment year 24-25, about 72% of taxpayers have opted for the new tax regime, while 28% continued to be in the old regime. Now, moving on, let's understand the two tax regimes. First things first, let's understand the new tax regime since a lot of taxpayers have gravitated towards the new tax regime. Now, what is the new tax regime? So back in 2020, the government had introduced a new tax regime with the intention of simplifying the tax system for taxpayers. Since its introduction, the government has made continuous efforts to make the new tax regime more attractive by lowering the tax rates. On the same lines, this year had a very significant announcement in the new regime for the middle class. Finance Minister made a surprising announcement
that there will be no income tax payable up to income of 12 lakh rupees.
The new tax regime aims for simplicity with fewer exemptions and deductions. While it offers lower tax rate, it forgoes many of the deductions available under the old regime, such as HRA, home loan benefits, investments under Section 80C, and insurance premiums. So what about the new tax rates and slabs? So 0 to 4 lakh rupees is nil tax, 4 to 8 lakhs is 5%, 8 to 12 lakhs is 10%, 12 to 16 lakhs is 15%, and about 24 lakh rupees is 30%. Now you might be wondering, didn't the finance minister just say no tax up to 12 lakhs of income? So basically, there is a tax rebate of up to 60,000 by which the effective tax liability becomes zero. If you're a little confused, don't worry. We will show you some examples later to explain this. Now, what is the old tax regime? On the contrary, the tax system that existed before the implementation of the new tax system is called the old tax regime. In the old tax regime, taxpayers are motivated to make specific investments to be eligible for tax reductions. This regime offers about 70 plus exemptions and deductions which allow you to reduce your taxable income. Several popular deductions include the 80C deduction, which allows reduction in the taxable income of up to 1.5 lakh rupees, followed by 80D, which is health insurance premium up to 50,000. Other notable deductions include interest on housing loan under Section 24, in which an individual can avail up to 2 lakhs. Then there is HRA and several others. Now, while the old regime offers several deductions and reduces the overall taxable income, it requires detailed record keeping throughout the year. Now, what about the old tax regime slab and rates? As you can see, up to 2.5 lakhs is nil tax, 2.5 to 5 lakhs is 5%, 5 to 10 lakhs is 20%, and income about 10 lakhs is taxed at 30%. Also remember, if total income is below 5 lakhs, there is a rebate of 12,500. Now, despite these high tax rates, several deductions and exemptions allowed only under the old tax regime help lower the overall taxable income. Now, before we look at some calculations, let's quickly summarize the tax regimes. New tax regime for a salaried employee offers a standard deduction of 75,000, therefore bringing the total taxable income of 12.75 lakhs, incurring no taxes at all. The old tax regime offers a standard deduction of 50,000 plus the several deductions and exemptions we explained earlier. However, the tax rates are high for high income earners. Now, moving on, let's jump into the calculations. Let's take an example of a person earning 12.75 lakhs. More importantly, this example is just to show you the calculations under the different tax regimes. Now, under the old tax regime, suppose you have a gross salary of 12.75 lakh rupees. Considering the most common deductions, we have arrived with total deductions of 4,75,000, which reduce your taxable income to 8 lakh rupees. And hence, based on the tax slabs, your tax liability amounts to 72,500. And then there is cess, which is a tax on tax. Considering the 4% cess on your total tax liability, it will amount to 75,400. Now, looking at the new regime, the finance minister did mention that there is no tax on incomes up to 12 lakhs. This does not mean there is no tax rate for this slab. Instead, the calculations will be based on the new tax slabs, but however, through rebates of up to 60,000, the effective tax liability becomes zero. Now, let's take the same example and see how much deductions you need to be on par with the new tax regime. Taking the same 12.75 lakhs example, you will need to have total deductions of 7.75 lakh under the old tax regime to have your tax liability as zero. Let's do this for some more income brackets and give you a proper taxpayer guide to selecting the most beneficial tax structure. But more importantly, it all comes down to the deductions you claim under the old regime. If you see the table on your screen, the last column indicates the amount of deductions you need to claim to be able to be on par with the new regime. Let's take some examples. Suppose your gross taxable income is 16 lakhs. Under the new regime, you will be liable to pay 1,13,000. Likewise, if you have deductions worth 6,18,750, the tax outgo between both the new and the old regime is same, which is 1,13,000. Here comes the important bit. If your deductions exceed 6,18,750, you can opt for the old regime, which will result in a lesser tax outgo. Now let's take another example. Suppose your gross taxable income is 25 lakhs. Only if your deductions amount exceed the threshold limit of 8.5 lakhs, it is advisable to opt for the old regime. Otherwise, the new regime is beneficial for you. Now, what can we make of this? You must choose the new regime if you dislike paperwork and want a hassle-free filing process. The new regime is ideal. It requires minimal documentation since it limits deductions. Secondly, the new regime is particularly beneficial for individuals earning up to 12 lakh annually. With a higher basic exemption limit and lower rates, many find themselves paying little to no tax. Lastly, if you don't have substantial deductions or prefer not to lock your money into long-term investments like those required under Section 80C, the new regime allows you to enjoy low tax rates without worrying about maximizing your deductions. Now, on the other hand, you must choose the old regime if you have significant deductions to claim, like hefty house and allowance, leave travel allowance, or investments under Section 80C, like PPF, ELSS, then Section 80D, and several others. The old tax regime can be beneficial. If you're living in Metro City and pay hefty and substantial rent, the HRA exemption can significantly lower your taxable income under the old tax regime. Lastly, if you're paying EMIs on home loan or education loan, the old regime allows you to claim deductions under Section 24 and Section 80CE of the Income Tax Act. Now, to conclude, choosing between the old tax and the new tax regimes ultimately depends on your financial situation and preferences. The old tax regime offers multiple deductions and exemptions, allowing for strategic tax planning and potential savings. However, it comes with a more complex structure and requires careful financial management to maximize benefits. On the other hand, the new tax regime simplifies the process by offering lower tax rates with minimal documentation. While it eliminates most exemptions and deductions, it provides greater transparency and ease of filing. To decide which regime is best for you, consider your income, eligible deductions, and overall tax liability. If you actively invest in tax-saving instruments and claim deductions, the old regime might be more advantageous. However, if you prefer a hassle-free approach with straightforward tax calculations, the new tax regime could be a better fit. Ultimately, consulting a tax professional can help you make an informed decision based on your specific financial profile and long-term goals. Now, moving on, there was another important event during the week, which was the Income Tax Bill of 2025 presented by the Finance Minister on 13 February 2025. The Income Tax Bill 2025 has been introduced in the Lok Sabha, making a significant step towards overhauling India's tax framework. This bill, which aims to replace the old Income Tax Act of 1961, streamlines the existing tax structure by reducing the number of sections from 819 to 536. Here are some key highlights of the proposed changes. Now, currently, India's tax system operates on two distinct timeframes. Previous year, which is a financial year from April 1st to March 31st, in which income is earned. The assessment year is the following year in which taxpayers file returns and pay taxes on the income earned in the previous year. The new bill simplifies this by introducing a single term, tax year, which will align with the financial year from April 1st to March 31st. This change aims to eliminate confusion and streamline tax filings. Secondly, the bill has been restructured to enhance clarity, improve readability, and reduce complexity. As a result, the overall length of the tax code has been significantly reduced, almost by half. While taxation on cryptocurrencies was introduced back in 2022, the new bill formally defines virtual digital assets and the tax treatment. This ensures that cryptocurrencies, NFTs, and other digital assets fall under a well-defined legal framework, bringing more certainty to taxation and compliance requirements. More importantly, the 5 existing categories of income taxation remain unchanged. Income from salaries, income from house property, profit and gains from business or professions, capital gains, and income from other sources. Lastly, the bill introduces a more detailed regulatory framework for non-profit organizations, outlining rules on taxable income, compliance requirements, and restrictions on commercial activities. So, when will this be implemented? The bill is currently under discussion in the Parliament, with further refinements expected. If approved, the Income Tax Bill 2025 will take effect from April 1st, 2026, officially replacing the old Income Tax Act of 1962. Now, to sum it all up, India is moving towards a more streamlined, transparent, and modern tax system. Whether you're a salaried employee, a business owner, or an investor, understanding these changes can help you make informed financial decisions. At the end of the day, tax planning isn't just about saving money. It's about aligning your financial choices with your future goals. So stay informed, stay smart, and make the tax system work for you. Now, having said that, this is me, Rahul Hassan, signing off. Have a great day and stay safe.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.